spoke about it before, Kay, that shouldn't, even if they cut bond purchases, shouldn't create too much waves unless it's obviously a bigger cut than many expect.
Yeah. I think it has been pumped up as quite a story, but I think if we look at the reactions as well in the market, and again after yesterday, there is this thing that the Japanese investors, and we know that actually the government is creating a new investment arm, are already happy with yields around 1% in the tens, and then a bit higher in the longer end. And I've got the impression that the Bank of Japan is, well, not the impression, they are well aware of that, and I think the market's perhaps coming around to the same idea that it's not going to have too much of an impact if they go below the redemption amounts that we see on a yearly basis, because now we are expecting that the Japanese investors are going to fill the gap. So yeah, that is watering down probably this this reduction, but we still need to see what they will say. Yeah, we have the Bank of Japan coming up next night. If they give us a stronger hint at a faster hike path, I wouldn't assume that it's a more aggressive one, but a faster one could be possible. So that's going to be what we need to figure out after the Bank of Japan. I think looking at the market reaction, looking at the yen crosses, we may see a bit of speculation today about what they may do, and then perhaps the yen, like, just getting back a little bit of what it's lost. That is all possible today, I think. But then we will see after the Bank of Japan if we will have similar kind of reaction as past the prior meetings. I think there is a fair chance. I'm not long or I'm not short yen right now, but I bought just a short term call in the dollar yen, and to play this kind of reaction also after the FOMC yesterday, and we'll see what happens next.
Yeah, very much so, mate. And that'll come tomorrow morning, and I'll let you review that because I'll be off on the Jellies the weekend. So yeah, all yours tomorrow, mate.
Okay. I'll do my best.
I'm sure you will. You always do your best, mate. Let's jump across the water to Australia, where we've got some jobs data out, much better than expected. Employment change coming in just shy of 40,000. So well up on expectations, also up on last month. Good news on the revolving door. The majority went to full-time employment, 41,000. Part-time dropped by 2K. Unemployment rate dipped as expected to 4%. Good news as well, double good, because that participation rate went up higher than expected. It also went up over last month, but last month was revised higher. So effectively it was unchanged, but it still beat expectations. But it's still positive news that the participation rate went up and unemployment fell. So good news coming from Australia there on the jobs front. Not that the Aussies paid too much attention to that data, though. Coming over to this morning, we had some German data, wholesale price index year on year, still a negative number, although we did see a positive 0.1% on the month, but that wasn't as much as expected. So no real pickup in prices coming through to Germany, a very disinflationed nation at the moment. As you can see there, we've got Spanish CPI there as well, all around expectations and confirming the move up over the prior month, that bumpy road that all the ECBers have been telling us about. And on that front, ECB's Patsalidis said that the next step will be data-driven. Our mate Penfold de Guindos said that deflationary processes have been quite profound. All measures of underlying inflation are going the same way. Says he doesn't know how many rate cuts there will be by the end of 2024. ECB's Nagel, inflation is coming down, but core inflation is still sticky. ECB's F.A.C.E, more 2024 ECB cuts are probable if the baseline scenario holds. ECB's Muller, we have not yet achieved our inflation target. It's possible inflation could temporarily rise again. Services inflation is still relatively high. Wage growth is still strong. It's too early to say when the next rate cut will happen. Right, coming across to the good old US of A, and lots going on yesterday. We've got obviously the aperitif from the CPI data, which all metrics came in lower. Headline coming in lower than expected at 3.3%. The core coming in lower than expected at 3.4%. That got the market making its move, and we pretty much reversed all the gains in the dollar that we saw on the NFP data. So we went right back the other way. The market all of a sudden moving, being a little bit hawkish to a little bit dovish going into the FOMC, which then put the risk on the other side that if Powell wasn't as dovish as the market wanted. What was a little bit stickier though was the wages numbers, the earnings numbers. You can see they're month on month coming in at up 0.4%. Real average hourly earnings, which is not on that calendar, year on year came in at 0.8% versus a prior 0.5% there. So hot numbers there. Average weekly earnings year on year came in at 0.5% from 0.6% previous. So as I say, still sticky wages, and we saw that in the NFP numbers as well. So right after that data, Fed swaps fully priced in a quarter-point rate cut for November, and then moved to pricing in 2 rate cuts in 2024. So as I say, the market getting siding a little bit less hawkish towards a dovish side. And then we got the FOMC, and really a mix of numbers and moves and comments and whatnot. So they moved the dots. The FOMC median now only sees 1 rate cut in 2024, though they increased that to 4 cuts or 100 basis points in 2025. They hiked their 2024 PCE forecast 2 pips to 2.6%. The core PCE up 2 pips to 2.8%. In the statement, they said they made further progress towards the 2% inflation objective versus the lack of progress that they put in the prior statement. Said that it does not expect it will be appropriate to reduce the policy target range until gaining greater confidence inflation is moving sustainably toward 2%. So they moved the dots up, but acknowledged the further progress on inflation, but said we're still not there yet. Powell was a bit of a waffle show. So I've just tried to pick out some of the choice headlines. He said inflation eased substantially, but is still too high. Consumer spending remains solid. The labour market strength is expected to continue. They're practicing a slight element of conservatism on the inflation outlook, saying that we don't have high confidence in our forecasts, that nobody has rate hikes as their base case. The rest was a bit of the usual talk on one side of the hawk dove line, talk on the other side, same old, same old. Long story short, they're still on the path to cuts. It's still, the light is still very far down the tunnel, still quite a way away, but the market is now back in the mood where I think we're back to where we were probably before the NFP, i.e. the market was taking a slightly less or more bearish tone on the dollar. We're going to be back to trading the data points and likely the dollar getting smacked on any minor miss or bad news. So that's where I think we've gone back to. Rate cuts are still in the pipe. Hikes are still a very, very slim possibility. Kay, your thoughts?
Well, I think you already summed it up very well. It looks well. I think Powell has a kind of a line under his rostrum, and then he jumps from one side to the other side of the line. It's you don't see it on the live, but I think he's doing it very quickly. And yeah,
maybe it's an electric wire, and if he goes too hawkish, someone buzzes him and zaps him, and if he goes the other way, someone zaps him the other way.
Yeah. That's like that's likely it. Yeah. Um, yeah. But that's it. You know what? This. Oh, it's tough to find a real message because and we can see it in the market. The market is not finding a real message either. But I think there's still this one thing that I hear when he speaks is that it's not as categoric. He cannot say that as categoric as he perhaps may like, but it says I think he clearly says no more hikes until unless we really there's a big accident somewhere or inflation really jumps up by back above 5% or so. But it's clear that in his mind there will be no hikes anymore. I wouldn't have called it as a uber hawkish, but it's an everything press conference and meeting that we had. Unhawkish, undovish. But the fact is that that the dots have just tipped over to only one cut from the what we may have expected to be two cuts possible, and then probably the dollar would have remained a bit under pressure after that weaker CPI. But yeah, I think we're exactly as you say. Well, yeah, you're showing it there. We are exactly back at levels where we were pre-NFP on the rates. So that shows that the market has taken the whole lot into consideration and just doesn't know where to go from here. So now we need. And this is going to be the story of the summer. Still, we are all very, very data dependent, and everything can change on a dime. And I would even add that if we see a bit of weakness, because it did make this very small reference to some private reports, not seeing the job market as good as the what is it, ILS or also comes up, BLS comes up with those numbers. So it did make a slight reference to it. So I think a lot can change very quickly because yes, they are at one cut now, but if the data would deteriorate even in the next month, I think they would switch quite rapidly back to two cuts. And that is sort of what I've taken away from it. Now, facts are that we are on only a one cut scenario. Yields are where they are, and in a way, the dollar is still in major land a relatively high yielder, right?
Yeah, and we're still in the same old ranges, and
We are.
this is what we've been stressing for every time we get these meetings. That the market is going to run from one side of the boat to the other. Okay, the Fed's the captain of the boat. Okay, Powell's the captain. He's on this boat. The boat's going straight forward, but the market is going to run from one side of the boat to the other, all around from the data point to data point. We've seen it, but you've got to look at the cold light of day. Review it all. What have the Fed done between the May meeting and this one? They've said they've got a bit further progress, but they've pushed potential rate cuts a bit further out because of that lack of progress all the way to target. So their path hasn't changed. The market, however, has decided to run around all over the place. And that's why it's always important when you go into these events, you have to know where the market's at. After the NFP, it went hawkish. After the CPI, it went dovish again. And then you can base your reaction to what happens. But you can't do it after NFP because you got the CPI. You can't do it after CPI because you've got the FOMC. So you just need to know where we're at. And that's how you judge it. Nobody in their right mind and, among the people in our chat, whenever, would have expected any huge breaks of any ranges. And, we look at euro dollar. What did it do? We had all that move down there, reversed on the CPI, and now we're bang in the middle again, all tapping around this 108 level. So we haven't gone anywhere new. We've walked in the ranges. If you plotted your levels, picked your range edges where the market may do something, then you may have got a trade. But if you're expecting 105s or 110s, then you're pissing in the wind, my friends. But here we are, and now I think the market we're back, as I say, to where we were pre-NFP. waiting for the next bit of data, and the market's going to move with that. Volatility is going to obviously pull back a little bit, and we're back to playing that game again. So ranges are still evident, and that's really what we look at.
Yeah, those euro vols are really not for seeing big ranges at all. They're actually in the short end now. We are trading below 5%. The 1-2 weeks on the euro dollar, we're actually below 5%. That gives you an idea of how the options market is looking at all this, and perhaps they did put up the volatility a bit before the events, obviously, but the way it really collapses again afterwards is just telling you that we have to really keep our expectations in check if we trade anything euro dollar, especially related. The rest may move a little bit faster, but the euro dollar is very much trapped here.
Yeah, exactly, and volatility is probably going to dip a little bit more next week when it's the football tournament in Europe. Although, unfortunately, I've counted, there's only 4 games on in the group stages that are during what we'd call a working day, 2 o'clock in the afternoon, which is a bit of a shame because if markets are quiet, I'm quite happy to stick the football on the screen and watch it. But they're all either 5 o'clock kickoffs or 8 o'clock kickoffs in UK time. So after the market's shut, which the missus won't be happy about because I'll be plugged into that most evenings. But anyway, Brian, you've asked a good question there. Is PPI likely not to move things today? Well, this is the first bit of data we get since the FOMC. It's inflationary, so it is going to be fairly important. There's no real big expectations for it. Core unchanged 2.4, PPI moving up 3 pips to 2.5% for the year-on-year number. So it could do, if there's a big variation, depending on which way it goes, it might add or take away a little bit to where the market's sitting now. You know, if it's a real hot number, then the market's going to go, oh, here we go again, and we get a little swing of the pendulum towards the hawkish side. So we see yields picking up, dollar picking up. If it's softer than expected, market's going to go, yeah, that's following the CPI data and adds to the further modest progress seen by the Fed, and we go that way. But it can be a volatile number, PPI. So really only likely to move things if we see a big variation in the numbers there. Obviously, jobless claims, we have the odd little minor wobble, but it's been back in its range, doing nothing, going sideways for more weeks. So only if we see, again, a big variation in the number there, will we likely to see something. Right, moving on. BOC's Macklem was out and about as well, saying monetary policy no longer needs to be as restrictive as it has been. Still need to get inflation down further to our targets. And bang in the middle of the FOMC, Banxico decided to release their financial stability report with a webcast from Central Bank Governor Rodriguez. The central bank said they're to continue monitoring the evolution of financial markets in Mexico and will take required actions if needed. They said the FX rate fluctuation could take time to reflect on the inflation rate. Then it said it can step in if peso volatility becomes extreme. So talking interventions, and said they have a 30 billion foreign exchange coverage program that could be deployed by the Exchange Commission. And then Rodriguez said the Bank of Mexico will be very attentive to developments in our markets and to the possibility that they show atypical behaviour or extreme volatility. And in the government, so there's a piece from the headlines in the government saying that they're going to start an operation to cut 100% of their 2025 external debt payments. Kay, they're not going to be intervening down here.
No.
Well, now it's been reversing, but maybe the comment on volatility needs to be kept in the back of the mind.
Yeah, a bit like Japanese MOF, right? If you see another few sessions of very high volatility, but it has to be read in the same direction as the Bank of Japan. The high volatility, in my opinion, will be like if it shoots up to, call it 20 in the dollar max, then I think we may see a bit of intervention there, you know, especially if it happens like, let's say, tomorrow or yeah, towards the end of the week, start of next week, and all of a sudden on Monday people come in, not a lot has changed, but Scheinbaum and AMLO are plotting to make their changes as soon as possible. Then all of a sudden the market can get spooked, and we hit 20 on the dollar mix, and then it would probably be reasonable to expect them to show up. But I don't think if it stabilizes here that we're anywhere close to interventions. I don't think so. But it's again all going to be about speed of the move, right? And and again, it's going to be the top side. If it collapses 50 or 3 or 5% or so, then we are back in the middle of the range, or back towards 18 or something that's not going to alarm anyone at all. And but I do think that some people may still be waiting for a move down there to try and buy it again. I'm not sure how much has been unwound, but since it's been the trade of 3 years to be long mix, it's there may still be a bit further to go, right? Although we are nearly 2 weeks in, and I think that may be sort of enough for now. Could be, but I'm just a price follower right now, and I missed to buy dips, and just watching it, you know. But usually I was very relaxed in buying mix, but I'm a lot less right now. And as I've been saying as well, we are slowly going into the second half of the year, and with the US elections coming closer, I said it's going to get wobbly into the US elections, but we've seen already what politics can do to a currency, which is still an emerging market currency. And even though they have like a very close cooperation with the US, the friend shoring, the near shoring still ongoing, being part of the USMCA, should, in theory, at some stage stabilize the Mexican peso, but we may still have a bit to go before all those carry trades have been unwound.
Yeah, what does look clear to me from a price action point of view is that when we're cracking the big levels, they really look like sort of capitulation levels. You know, we've had these spikes above, but you know, this secondary move, bosh, off we go. 18, we've had the spike, but then the secondary move, bosh, you know, then in a blink we're at 1850, we smashed that. You know, we hung around for a bit, but then we broke it. So it seems every time we break these big levels, and it's probably going to be the same further up, there is a decent amount of follow through. But there's also a lot of volatility. So, you know, we smashed up to 19 and came quickly back down to sort of 1860s. So there's a lot of vol in there. But I think that, as I said, week or so ago or whatever, the more we break these sort of levels, the more longer term carry traders start to get twitchy and start to think about taking what profits they've got and moving out. But we shall see what happens from here. Certainly been a strong move, and I'm still long. I took a long after the FOMC, a very small long after the FOMC yesterday because I was waiting for a decent dip, and I see no reason to try and fight this move at the moment, but rather go with it. But we shall see where it wants to go, and we could have a bit of a decisive moment today when the market sorts itself out what it wants to do with the FOMC. Right, last bit of news in politics. Macron looks like he's getting a bit twitchy over his decision to call an election. He's now inviting other democratic parties to join the presidential camp ahead of the election. So he's trying to firm up his position against the right. Again, ruled out the possibility of his resignation after the French election. And that's probably not a surprise because it's almost saying you'll resign if you lose the election is almost tempting to get people to vote you out anyway, just to see that happen. So he doesn't want to put his neck too far on the line, shall we say. And over in South Africa, we're getting closer and closer to a potential new government as the ANC and DA continue their talks and are closing in on the differences between them. That's it on the headline front. Oh, look at that, half an hour for that lot. Anything else for anything else, Kay?
No. I think you covered absolutely everything there. We're good.
Thank you very much. Right, let's have a look around. Stocks. Let's start there, shall we? Because they had some fun and games. So this is, we've got FX markets which are showing a bit of indecision over what it all means. And then you've got stock markets who are just sticking their fingers in their ears and going, thank you very much, and running off into the sunset. Big break up here. I haven't updated my chart for a while, but we have to do the old drawing patterns again, get the levels in, see where the support is going to be wanting to come in. We're looking around this 53, 60s, 70s area. Is probably where we're going to be looking for support. We've got some minor lows coming in there. We've had a high that's been tapped twice now, so that gives you a short-term level to lean against. But it's really all about painting the picture up here and whether these moves can be sustained. Again, we'll remain to be seen what happens with the rest of the data. Kate, there was we've got this buyback thing finishing tomorrow. It's the buyback deadline after which firms can't buy back their shares. Do you think that's been a big part of this rally, that everyone's just shipping in the buybacks before the block comes down?
It will have been. I think it's a partial reason why we are here. The rest is still relatively liquid markets, and that's what I've always saying. Money creeps where it can make more money, or where there's more money to lying around. So it's going to be an interesting day tomorrow, and perhaps the opening of the next week indeed. See if we can hold above that 53 3/4, 53.80. See if we can 70.80, let's say, if we can hold above there starting next week. I've reduced a lot of what I had. I've bought that break of 52.80 the other day, and been gradually scaling back, and now I've got like just a little bit left, and I'm protecting my profits just under 53.80. But yeah, I mean, it could have a bit of a setback, especially if by then, let's assume that we get PPI numbers. What are they expected today? I'm just trying. Where are they? Well, around where they're expected, like the 2.5 mark. Which would be a little higher than last one on the year and year. If we get that bit stickiness still in there, perhaps we can see a little bit of a setback coming in. Start of next week or end of the session tomorrow. But then again, we have to watch, as we say, what happens then. The close tomorrow, the open next week. If you're still around, if you're still at 54.25 or above, what's going to be the reason for selling it? That's again, it's always the same question. Do you have a good reason to sell it? Because I mean, we have to call a cat a cat here. I mean, the retail market is constantly looking for tops, constantly trying to fight this, and constantly running into a bit of trouble. We need to find reasons to sell stuff, okay? And just one data point again is not enough. I mean, yesterday the CPI was a good reason to keep it bid. But then the FOMC, Powell himself said, like, yeah, well, that's just 1 month of data. We need to see more. But yet the equity market is holding up, and we will see after the deadline of the buybacks how it reacts. It can come off. I mean, indeed, it can come off if that was a big part of it. it can indeed come off, and then you have to see how we trade around around 53.70.80. But again, look for decent reasons for this to go up. And I'm going to tell you one big decent reason. When I am going to stop trying to buy equities when that jobs market really starts to weaken, then I think, to me, that's going to be, for me, enough of a big signal to stop buying equities. Even if they go another 50, 60, 100 points higher afterwards, I won't be participating in it anymore, because I think that is the one big major domino, bigger than the inflation, in my opinion, to stop buying stocks. If the job market falter, then there's going to be much more trouble.
Yeah, I think I could agree with that then, because that's going to show signs of a proper weakening economy. And if people are losing jobs, they certainly aren't going to be splashing out in the stock market.
Exactly.
And, yeah, and I think that this it's going to be crunch time come Monday, I think, because, you obviously got people who are going to be chasing this move higher. And if there is a big driver from these buybacks, if that bid isn't there on Monday, everyone who's long is going to go, well, who's going to run this higher? And at that point, if no one's running it higher, that's when people go, uh-oh, I better get out. And that's when you see a pullback.
Yeah.
So that, there's moves that are, building, putting brick upon brick upon brick, and it's something solid. And then there's moves like tossing a tennis ball up in the air. It gets to the peak, and then there's no impetus left, and down it comes again. But so I think Monday is going to be crunch time. If you're long stocks, just watch the price action and see what happens.
And there's a good target around 5,500. I've been saying in the room, if I see a runaway train up into 55s, I'm going to be a happy camper taking profit, and then see what next week is giving us. Perhaps tomorrow we have this little bit of a runaway on the last day of those. As you say, on the last day of those buybacks, and then see what happens next week. I'm going to be a happy man at 5,500. That's a nice return for a few days of work.
Yeah, very nice, mate. Very nice indeed. And yeah, if I see that, I might even think about a little short if we get that 5,500 to tap the big figure for a little scalpette. But we shall see.
Above it's 56. I don't. Well, probably people will see like extensions also somewhere in the middle, but above 5,500, I don't see much above there until 5,600. So, but it may be a really good and a timely try out to go for. Just try a little one, because if it is really due to the end of the buybacks that you have that little spike higher, that would be like perhaps a really nice one, and then you walk in on Monday and the bid's gone, and then you find yourself at 5,400 or 53.70 would be enough, right? And then see what happens there. Just see what happens there if we get back down there. Yeah, it's actually not a bad idea, man, at all.
Cool. Right, well, let's get. I'll have to tell me where you go offered, mate, so I can jump a pip ahead of you.
Yeah, as we usually do, don't we?
Vultures. Get the vultures out.
to help each other out, as we say.
Exactly. We don't have doves and hawks here. We have vultures. In front. Right. Quick look at yields, because this is probably, you want to be watching the yield space today. Because if a decision is going to be made over the Fed, this is where you're going to see it play out, and then obviously reflected in FX and the dollar and whatnot. So as you can see, even though with that dots move up, suggesting less cuts this year, the bond market is still saying we're on the path to cuts, and that's the way it's siding at the moment. So keep an eye on that. We did make a bit of a low of the recent lows that we've seen around 427, 428, heading down to got a bit of a level here at this 420 area. It's been a fairly long-term level. We've messed around there quite often, and it's sort of your hawkish dovish line, shall we call it? This is in 10 years. So watch a reaction down there. If we move down there, dollar weakens a bit, but we hold it, then that's probably going to put the brakes on in the dollar move, and then we'll probably go sideways from there. I'll just look at gold quickly. It's been all around the houses again, but it's still holding within this range. We cannot get a proper close below 2300. And I think while that's the case, longs are going to be still in the game for this one, but watch the bounces. We are, as you can see, we're just potentially making lower lows, which will keep the pressure on this level. So if we do get another move under 23 pretty quickly, that might be the one that leads us a bit lower. But then obviously you've got to take these prior lows into consideration. But if we get down there, hold that bounce, and then start to find resistance around 23, that's going to be a signal that we might be breaking that range. So one number, that's all you really need to worry about, 2300 at the moment, and whether we can start holding below it. Then you focus on the prior lows and see what it wants to do from there. Kate,
it may be an interesting watcher, those metals, because if you have a little bit, okay, it's a bit of a conspiracy theory on the S&P, but we have seen that people do either trade stuff together or rebalance from one asset into another. And imagine that there is something that we talked about going on in the stock market. It's perhaps going to be an interesting watch, those metals as well, because we've seen the market quite often jump from one asset into another, right? And or drag them the same way. So imagine that is just like okay, get out of some investments, get out of some speculative plays. It might cause your break down or a break higher inversely in the metal. So start of next week may be really an interesting one as well for multiple assets which are not really FX, pure FX. We don't hear you, Ryan.
Yeah, I'm just going to have a quick look at euro sterling before I knock it over to you, mate, because Ali's asking. Right, obviously next week's big for the UK. We've got CPI data day before the BOE announcement. So obviously we'll get into that in greater detail next week, but that's the risk event for the quid. The techs are pretty clear. We came down, tested this zone that I've had in my chart for ages and ages, down towards 84.20s. Did dip a little bit into it, but it's a bit of a zone down to the big figure. We've bounced thus far. This is probably more a case of just cable moving a bit more than euro dollar at the moment as those vols come down. So we're still playing this ping pong game. We've confirmed around this 84.20. We're not really yet confirmed what we want to do at the top side. We haven't got down to managed to get up to the break point high after the break, after the gap. So we haven't really tested the upside. So I still don't know what we need to do here. If we get a test and hold, that will obviously confirm the break, and then we can play that game between 84s and 85s, basically, which, as we know, could take weeks. So if you're looking for a trade here, if you're buying off this line, Ali, you're thinking about what are you thinking about? Pound weakness. So you want to go long. So your entry level. If you're going long here, you're bang in the middle. If you didn't go long here, you might want to think about it. What you want to do, wait for these levels that have confirmed. You say it's a long-term trade, but you've got a reasonably tight stop. So if you mean you're going to put on a trade that you want to hold for the longer term, that's a bit different to doing a long-term trade. But yeah, if you want to trade the levels, try and stay in as long as possible. The BOE next week, briefly, is going to be a big event. The market has pushed out its rate cut forecasts. Personally, I've seen evidence why the BOE would move to a sooner cut than expected. I don't think they should cut this soon, but inflation has come down pretty significantly. If we get a number next week under 2%, I would say that the chances of a cut next week will probably be up around the 80% mark. It's not that I think they should, it's I think they'd be stupid enough to actually do so. At the very least, on a real soft CPI number, I think the votes will at the very least indicate probably a 5-4 in favour of keeping rates on hold. So really moving to the tightrope, shall we say, or the pivot line between holding and cutting. And that will be an indication for August, most probably. But anyway, that's that from Euro Sterling, where we got questions to ask between 84s and 85s. I'm not ready to take any trade here at the moment myself.
Yeah,
Over to you, mate. Oh, sorry,
me neither on the Euro Sterling, because I mean you're also struggling a little bit. You got the Bank of England, you got data out of the UK, and then there's those wobbles in European politics, and you're talking about Euro Sterling, like the two currencies which could be affected by one or the other event come next week or the weeks to come. So. I think it's a tough one to pick a side here. We can say that we are confirming the break of 84, 90, 85, but on the other hand, yeah, now we're back in the middle of that 84, 85 range, and I think there's from the non-technical side of things, there's enough uncertainty to for me at least to stay away from it.
Yeah, very much so. Technically, it looks like a break, and technically, it should mean it has legs because we spent enough time above this 85. But technically, it doesn't matter when you've got a bank like the Bank of England who can mess up your plans or make you gold, depending on what stupid decision they decide to make. Anyways, clock is ticking. Let me punch it over to you, mate.
Yeah. I'm just going to show a few because I'm looking at the time and we don't want to take too much time away from you guys today. On the euro dollar yesterday, going into whatever happened, CPI, the meeting, I said like, well, watch this 35.50 zone on in the 108s, and that's exactly where we went. You know, we tested that trend line, and then the FOMC put it back down. But as you can see, we're turning around really neutral level and go back where we were before the NFPs. Look at where we were. We were right here. So, and the vols are coming off in euro dollar. I don't think there's a lot to do. I'm a little tiny bit short, but I'm going to watch what's happening again in this 108.35.50 zone after the PPIs today. I don't have a lot of confidence in the euro. That's why I picked the euro as a small position. But I don't expect us to go anywhere. Not even down to low 107s. I'm going to be happy if I get like 30-40 points on half of it, and then reassess going into the end of into the end of the week. One interesting one, and indeed, cable went for a walk above our 128.25 zone. We went above, but then there's some longer term moving averages. I'm not a big fan of moving averages, but it actually stopped right there, and at your next level, and now we are back down. I don't see too much of a trade right here and now, but this is one that we are going to get ready, need to get ready for, and I'll talk about it since Ryan is off tomorrow and on Monday, I guess, as well. Ryan, you're off, right?
Yeah, I am, mate.
So perhaps on Monday, I'm going to prepare the week and see where exactly cable could end up after CPI, Bank of England, and everything, and then we'll have a look at all that stuff. For the time being, I think rangy. I would suspect that any move down to low 127s will find support as well. There's not too many reasons for it to completely come off either. Bank of Japan, Bank of Japan, and we are back above 157 in the dollar yen. That's what I've been saying for a long time. Look at all the yen crosses. Okay, we're coming off a little bit, as I said at the top of the show, perhaps a bit of speculation about what the Bank of Japan can do. So I wouldn't rule out a bit of correction here, but watch out if the market reacts again compared to what we have what we had after prior Bank of Japan meetings, what we had yesterday again after the FOMC. It is coming back very, very easily still, in my opinion. So I don't have anything in cash in the yen right now. I did buy a small call just in case we have the same kind of reaction as prior to the after the other Bank of Japan meetings. It'll depend on what Ueda says about the rate path, if he already says a lot. But I really do think that all else equal, it is possible that whether it's the dollar yen on itself or all those yen crosses, if you look, for instance, at a pair like the sterling yen, we are above the 61.8 of the really long term, and we are well above we are above the latest highs as well, and that thing is just beat like hell. And it's the same like for every yen pair. If you look at the Kiwi yen, it's the same. Aussie yen, because of the relative difference between the Aussie and the Kiwi, that's still banging its head against that 105. But Kiwi yen, for instance, has gone for a walk above the channel and already shown up as a support in the 95s. And this one could be on our way to why not those highs again. We are not too far away, 2007 highs before the global financial crisis. And what happens if we break above there, you know? I mean, and that's the thing about the yen. You don't only have to look at the dollar yen. This is also a case of all those yen crosses. If they stay big, your dollar yen will have a very tough time to stay low if we get corrections. Okay. Rand, I finally started, because I was looking at this 34, 38 zone. We are smack in the middle. My real plan is to try and buy low 18s, but I did just a tiny bit just in case we are starting to hold here. I didn't want to do it before CPI and FOMC, so I missed the actual low, but decided it's time to just catch just a tiny one, and then I'll be looking to load a little bit more up when it goes lower. And really for today, I think that's enough. Interesting. Oh, one last thing. Despite whatever goes on in the European zone here, Euro Swiss is starting to go back above 96, 70, 75. Look at where we are at the close of the day. This could be relatively significant if we start to hold that level again. Okay, this is one to keep an eye on, which will in turn drag all the other Swiss pairs higher as well. I'm still in this one as well. I'm long Kiwi Swiss from here about. This one is looking pretty good as well. I'd love it to start breaking above those mid 55s to have a look again at what's happening in the 56 zone. And with that, Ryan, well, Ali, I just spoke about the Euro Swiss, right? I think it's could be significant that we are back above these 96, 70, 75. Okay, and back over to you, Ryan.
Thank you very much, mate. I'm just sorry. I'm just looking. The UK Labour Party has released its manifesto, and just looking at the details there, see if there's any implications for taxes which might impact the market. But I'll go through that in the chat room. Aside from that, thank you very much, Kate, as always, and thank you guys and girls for coming to the Flow Show. Yeah, we'll just be K-Man for tomorrow and Monday, and I'll be back on Tuesday. Have a very safe trading day the rest of the day. Have a great rest of your week. And Kate will see you tomorrow. I'll see you Tuesday. Have a good one, everybody.